Long-term wealth is literally a math formula. It is a second grade, absolute, without question math formula. In fact, really huge wealth is second grade math repeated consistently. You're going to have to understand risk. Now, I like the word risk because the word risk and the word rich sound very similar. They both have 4 letters. They both start with RI, and they both really require you to do something specific. But risk gets a bad rap, I think, because it doesn't mean that you have to lose all of your money. Understanding the risk, understanding the math of the risk, and knowing exactly how to play it, that's a really, really big, beautiful way to wrap up something.
What's up, everyone? Hope you're doing fine as always. Today, I'm coming up with a good interview with Jerremy Newsome. This is not your typical trading interview where we talk about charts and trading in the market. We really focus on 2 things in this interview. First of all, wealth, how to build wealth with trading and in the stock market, and also how to actually go into a more long-term picture view of the market. Jerremy calls it how to swing and invest. It's like a mix of investing and swing trading at the same time. So you get to see that in the video today. It's a really impactful interview, definitely some good knowledge about the markets and about wealth. I'm sure you get a lot out of it, especially if you want to build wealth, be part of the top 1% financially. But just before we jump right in, if you haven't gotten this book yet, my book, Profit from Trading Secrets, it's available now on all the bookstores, Amazon as well. You can check it out. In this book, we interview 13 full-time traders who trade profit from account or have built their own private funds. You get to see some of the behind the scenes, what habits they have, what lifestyle they follow, what rules they have, what strategy they trade in the market, everything that makes them successful, basically. So check it out. It's going to be available everywhere. I'll put a link below so you can also use that link to grab the book. And now let's jump right into the interview. All right, sitting on today with Jerremy Newsome, someone I like to talk about to every single time we talk. We have a chance to discuss about trading, about the markets, about wealth also, kind of how to build the right mindset for building wealth. So Jerremy, welcome back on the podcast. Good to have you here. I look forward to chat with you.
Love being here, man. You're in Japan. I'm in Vegas, all the way across the world, making magic happen. It's amazing.
Definitely. A few minutes on what's been going on since we last spoke. I think it's been a few months from now, maybe 6 months or 1 year. So tell me what's been going on since then.
Yeah, it's been a hot minute. So I traveled the country in an RV with the family, and we were looking for a place to live. We wanted to find a really great spot that had all the things that we were looking for. And we settled down on Las Vegas. So me, my wife, the 3 boys, that's where we live now, living in Las Vegas. We'll be here for a little bit. And working on writing some books, doing a lot of stocks and options trading. I mean, that's kind of always been my jam. Obviously, trade crypto here and there. Been doing a lot of futures trading here and there. And I've started working with some individuals that are in the top 1%. And I'm working on really expanding the top 1% and the top 2%. That's like one of my big goals right now, is just working on wealth and expanding wealth, people's individual wealth, so that their legacies, their families can expand and really help more people and provide more abundance, more opportunity, more prosperity. So it's been a really, really great, fun time just coaching and traveling and hanging out with great people like you, man.
Let me start with this. It's a good way to kind of go into it. What does it take to be in the top 1% these days, or the top 2%?
Believe it or not, a lot of it's based on age. So it's really age and income are probably the 2 biggest factors. And it's probably not as much as you think. So if you are under the age of 40 and you make more than $200,000 net per year, you're in the top 1% of the world, which is pretty remarkable. Now, over 40, it starts to get a little bit dicey. 40 to 45, it's like you got to make about $400,000 a year. And then over 45, you got to start doing about $650,000 a year plus. And at that point, pretty much from there on out, you're in the top 1% of the entire planet. From just an income standpoint, it's a very interesting minority that I don't think a lot of people actually talk about, right? A lot of people always talk about minorities, but to be in the top 1%, well, that's what it is. Like, you're in the top 1% of all income earners on earth. So you are, by definition, a minority.
That's pretty surprising. I thought it'd be a lot more than that. So
congrats to you, man. I think you've hit some top 1% numbers recently, bro. So proud of you. You're doing awesome.
I appreciate that. So you are certain kind of people to go in the stock market to invest, to build wealth. Tell me how that kind of plays out with all of that. Do you just go in the stock market and that's kind of how you make your overall money? Or is there other strategies or things you can go into to build wealth?
Yep. The stock market is the most efficient way to build wealth. It's the quickest way. It's the fastest way. I wouldn't say it's the easiest way, but it's very quick and it's very fast. There's a lot of opportunities there. It's extremely explosive. It's extremely volatile. It's very, very misunderstood. That's what I have learned. Working with, ultra high net worth and high net worth individuals, I've learned that most of them have an understanding of the stock market. They have a very, very good understanding of business, real estate, and usually private equity. Private equity meaning, they own different parts of companies and they own different percentages and they're buying into it. But very, very few wealthy individuals actively trade the markets. They usually give their money to someone else, but they're very, very much tied into real estate. And again, what I've also really run into over the last couple of years, man, is that the people that have the most amount of wealth, a lot of it is on paper. And what that means is it's not cash flow. It's not liquid. It's business ownership that says, "Hey, my business provided me this amount of money this year, therefore I am worth this amount of money." It's very, very paper-based net worth on a lot of higher income, higher wealthy families. That's really what it is. And again, it's not a bad thing by any means, but it's just ownership of assets that are going out and doing things that are, people are living in those things. They're living in apartments, they're living in hotels, motels, or you have, industry complexes. You have people that are actually creating items, you have factories. So things that are actually producing, creating assets for other people as well. A lot of high net worth individuals own those assets. And so that's what a lot of their net worth comes from.
We'll get to the trading part in a minute here. I know you want to talk about hedging and that kind of stuff, but do you think that you need to take risk to build wealth? Is it required to kind of risk a lot, that you kind of do risky things to be able to build wealth long term?
Oh, okay, cool. Good word. Long term, no. Absolutely not. Long term wealth is literally a math formula. It is a second grade, absolute, without question math formula. In fact, really huge wealth is second grade math repeated consistently. Short term wealth, yes, you're going to have to understand risk. Now, I like the word risk because the word risk and the word rich sound very similar. They both have four letters. They both start with RI, and they both really require you to do something specific. But risk gets a bad rap, I think, because it doesn't mean that you have to lose all of your money, right? So living in Vegas, a lot of people always talk about gambling, right? Gambling, gambling, gambling. When I go to the casino, I don't gamble, right? I follow a system. I'm aware of the system that I'm following. I understand why I'm doing it. I know why I'm doing it, and I know how much money I'm okay to lose. That's a risk formula. Every single time anyone makes an investment, you're going to have some type of risk. If you drive a car, you have a risk. If you eat a cheeseburger, you have risks, right? If you go on a run or if you ride a bicycle, risks are everywhere. Understanding the risk, understanding the math of the risk, and knowing exactly how to play it, that's a really, really big, beautiful way to wrap up something. Long-term wealth, man, spend a lot less than you make. Take a large excess of everything you earn and buy one individual asset with it repeatedly. That asset can be real estate, that asset can be a business, or that asset can be stocks. It's going to be one of those three things. But if you do that, you will be wealthy. I mean, it's a guarantee. It's not even a question. Most people, though, find it much easier not to save up a large sum of money. They find it a lot easier to spend money, so they don't really have any investing income to really put into something that could move aggressively.
If you had to build wealth, would you go into trading or would you prefer investing instead?
I do both, man. I do swing vesting. It's kind of like my jam. And what that means is like you don't have to be in a position for a long period of time to create incredible wealth. But if you understand and really see how many opportunities there are, not only in the market, but just in every day, every week, every month, every year, there are countless. There's more money making opportunities every day that we can take advantage of in a lifetime, my brother. Like that's an incredible, incredible thing. So let's just take NVIDIA really fast for the last like 2 years. So NVIDIA has had over 40% plus overall stock appreciation moments in time in the last 2 years. 40% gains. So let's just say, imagine for a moment you took 100,000, you put 100,000 into the market, and you made a 40% return 5 separate times on that money. So 100 became 140, right? 140 becomes almost 200. Almost 200 becomes $250,000. $250,000 becomes three and some change. Three and some change becomes 400,000. So in the course of 2 years, you take 100,000, turn it to 400,000, right? With that compounding interest on NVIDIA, right? The largest company on earth. You could have done the same thing with Apple. You could have done the same thing with Google. There's plenty of opportunities where you don't really have to truthfully spread yourself around and find the next greatest, coolest thing. Sure, you can. Absolutely. Especially right now in this market, there's been, and I'm not in any of them, stocks have gone up like 1,000% in the last 5 or 6 months. I mean, it's amazing to see that growth. You really, truly don't have to catch moves like that to build wealth. What wealth is a compounding effect, my man. If you take $1 million and make a 30% return, that's $300,000. Obvious math. But the majority of companies that will move 30% in a year is most of them. Most of them. So if you can look at a position and go, yeah, this is actually quite low, I should be buying it. And then you go and buy it, like Costco right now, in my personal opinion, is one of the larger companies that is low. NVO is another one. Huge company that's relatively low. You can go out and look for discounts. You can go out and look for good positions, and you can apply that money economically towards good positions, and then you can wait. And then if that 30% happens, you do not have to go, all right, cool, well, let me just hold this for the next 6 years. It's like you made a 30% return, which is what most people want to do in 2 years. If you did that in 4 months, sell it and go find another one. Or buy the exact same stock 2 months later for 10% less than you sold it for. So yeah, you really don't have to invest forever, man. You have the ability to interact with the markets, to interact with positions. Same thing with real estate. In the US, it's one of the coolest wealth generators in the world. I tell people all the time, if you move every 2 years for 10 years, yes, it's a commitment. But if you buy a primary residence in the United States of America, fix it up, put a little bit of time and energy into it, 2 years later, you sell it. All the money that you make from that is tax-free because you don't pay taxes as a married couple in the US on $500,000, up to $500,000 for a primary residence. Man, that's an incredible opportunity to roll cash tax-free for 10 years. Like that's a guaranteed way to become a millionaire.
If you are enjoying this interview so far, then I think you'll like this one over here. I've been working on this book for a long time called Prop Trading Secrets. It's finally out. You can get it in your favorite bookstore or on Amazon, Barnes & Nobles, of course. And this book is really about interviewing traders who are successful in either trading for prop firms or managing their own private fund. We talk about their background, what makes them successful, the things they went through, struggles they had to go through to become good traders now, and a lot of the good wisdom that you might not necessarily hear about, but it's all into a condensed version over here. You can read through these stories, get inspired, of course, learn a lot about what they do, their strategy as well. And we summarize everything at the end where you have a whole chapter of summaries of what these traders have in common. So if you want to check it out, 14 traders in this book that myself and Kathy Lean interviewed. There's a lot of good wisdom in this. If you like these interviews on YouTube, I'm sure you like this one for sure. Go grab it. Like I said, it's on Amazon, Barnes & Noble, it's on Audible and audio version. All the other audiobook platforms will have it too, or your favorite bookstore. So check it out. If you did read it, let me know in the comment section below which one is your favorite chapter, and we'll get back to the interview. I guess the trader would say, well, it's risky to put all your money into one stock and wait for it to increase by 30-40%.
And they would be almost correct because, as you know, there is something in the market called hedging, right? And when you use the word risk, there's awesome, incredible mathematical components to protect yourself in any situation, in any environment. Because if someone put all of their money into the market, all of their money is probably not that much money compared to how big that stock is. Right? That's the other thing. So let's just take NVIDIA, for example. NVIDIA is going to be worth $5 trillion by the time that this episode airs, probably. $5 trillion. That's the market cap of NVIDIA. I mean, that is a ungodly amount of money. So if someone puts in $10 million into NVIDIA, are they really putting in anything that's risky? It's like you don't think something that was worth $5 trillion is going to be worth $5.5 trillion in the future? Like it's going to keep going. That's what the trend of all companies that have become that valuable have done, right? Google, Apple, Facebook, all of them. Amazon, they're going to keep growing because they're going to keep growing. Like that's the beauty. That's the gorgeous part of it. But what if something crazy cataclysmically insane happens? Well, me and you both know, and a lot of listeners, hopefully this is informative for them, but you can buy what's called a put option. You can create an insurance policy on the largest companies so that if you put in $10 million, all of your net worth into just one stock, it's actually less risky because it's probably more boring, right? You're not really doing very much. Mark Cuban has 3 main investments: Bitcoin, Amazon. Those are his 2 largest, liquid investments, Amazon and Bitcoin. It's like 65% of his net worth is in Amazon and Bitcoin. It's liquid. I mean, that's incredible. But there's tons and tons and tons of people that concentrate to get rich, that take their money and put into something that's massive, that put their money into something that's huge. And then they can use hedging principles like options. Options are a phenomenal tool to protect your downside. If you have $10 million worth of NVIDIA and you have a put option that protects yourself from that stock going down, well, what's the risk? And then someone might go, oh, well, the risk is the insurance that you're paying. I'm like, wait a minute. So to protect all of your money, the money that you're spending is a risk? Like, which one is it? Is it the money you put in or is it the money you're spending? Because at some point, right, at some point, you got to give yourself a little bit of credit. Now, and then if the stock starts going up, well, you already know this, my brother, but you can start renting out your stock by selling a call option, bringing in income, and still getting cash flow. That cash flow can either A, pay for your insurance, or B, give you actual money while you are waiting for your asset to appreciate. That is just one of the coolest life hacks I've ever been a part of. Because even if you're like, man, I got to wait 7 whole months for this thing to appreciate 30%, right? While you're waiting, you can still get an extra, call it 1% a month in net cash flow while still having your downside protected. It's just it's just the most amazing wealth hack of all time.
I'll explain it definitely. It's a good hack for sure. I've been playing into option a lot more recently, in the last like year and a half or so. And I totally agree. It's a good way to do it. So
Yeah, bro. Good for you. I love it.
So this means that the advice of, oh, you got to diversify to be rich, like don't put all your eggs into one basket, it kind of doesn't make that much sense then.
Well, yeah. What if you have a lot of chickens? Right? If you have a lot of chickens, put as many eggs as you can into one basket. Or what if the basket can't break? Or what if you have a conveyor belt so you don't have to worry about the basket ever falling? I mean, it's a very interesting thought process, but the truth is like, well, what if I have other things to eat, right? When I hear the term "don't put all of your eggs into one basket," if the basket can break, meaning it's a company that could go to zero, and there's thousands of those, right? Apple, never going to go to zero in our lifetime. And people can argue me. They've been arguing with me for 10 years about it, though. I've been saying this for 10 years. Keep arguing and it'll keep being here and you can keep arguing, right? So Apple, not going anywhere. Unbreakable basket. Google, same thing. They make too much money. There's too much revenue. There's too much income for these companies to go bankrupt. It cannot happen. All right. So JP Morgan Chase, another one, Visa, MasterCard. So now if the basket can't break, you start really getting a beautiful concentration. Fantastic, fantastic strategy. Concentrate to get rich, diversify to stay wealthy. You will have to go through drawdowns. Warren Buffett has said it in every single one of his books. If you love one stock, be prepared to sit through a 50% drawdown, right? At some point, NVIDIA's done it recently, back in April. Apple's done it semi-recently, back in February, March. Google's done it. Amazon's done it. They'll all do it. Silver's done it. Gold's done it. Bitcoin's done it. Real estate's done it. They all do it at some point. So yes, you're going to have to hold through this retracement. I think most people probably don't realize that or expect that. But man, there's a lot of misnomers in the world about rich. Here's another one for you, man. You know what term I really don't like a lot? Filthy rich. I've never understood that. Because I have personally never met someone in my life who was very rich who was filthy. Their car was always clean. Their house was always clean, right? Like they, as a person, generally dressed nicely. They showered often. They went to the salon or the barber and got a haircut and their beard trim. Like they usually looked pretty kept. So I never understood the term filthy rich. So there's a lot of those appropriations to the market that I just think are incorrect. Like when someone says 95% of people lose in the stock market, over what time frame? Like, what are you talking about? Like that's just an inaccurate statement. Over the course of 10 years, that's almost 5% of people would lose. Like it's a very small number. And if you do say 95% of people lose in whatever time frame you're talking about, cool. What about the 5% of people who win? Who are they? That's a massive number. 5% of people who are winning. I mean, if the world's wealth is controlled by the top 1%, which I think most people would agree that it is, let's make that the top 5%. Right? That's again the thing is like 5% of people, if they make money in the market, that thing is just a huge number.
I mean, people have been talking about the market crash for the last 10 years, and it probably will happen one day. Like you said, it's probably going to come at some point. How do you get ready for this when you are investing or swing investing in the stock market? How do you make sure that it doesn't affect you that much?
Great question. So one of the big ones, man, is very, very common, very popular, trim and trail. Number one, trim and trail. I learned this one from Dennis Digg, Joel Elconin, Scott Redler, where it's like, hey, if you're up a bunch, you're up 100%, sell half, hold the rest forever. If you're up 100, if you doubled your money, and that's why I like that you're trading stocks now, because in Forex, it's very hard to make 100% return. I mean, it could definitely happen. But in stocks, it's almost a guarantee. It's like you can absolutely find a stock that's going to double over a long enough time horizon if the revenue is increasing. So you find a stock that doubles, sell half, hold the rest forever. That's a great piece of advice. Like you can never lose on that now for the rest of human history. So trim and trail is a beautiful one. The trailing is trail your stop. So just because the stock is moving doesn't mean that you can't have a position where if it's like, hey, if it breaks this level, get me out. Because right now, like the S&P, like we need a 2 to 3% drop desperately, really, really badly, very badly. We need a 6% drop pretty badly. And that's going to happen at some point. But you're exactly right. Like in a situation where the stock and the market trends really nicely, some of the hedging principles I do is I'll trim and trail. The higher the market is, the more cash I have. So right now I'm in like 60% cash. I did go all cash not that long ago and had to get back into the markets. And right now I'm still being nimble. I'm still being smart. I'm chasing some high quick movers. I'm taking some fast profits. But that's the other thing. As the higher the market goes, the quicker you should be with your profits. Make sure you have a base level of cash that you're ready to deploy and learn options. I'm so happy you're in that world now, man. But learning options, that's why options were created. They were created in the 70s for insurance position. So when a market goes really, really high, you can and you do have the ability to protect your downside. Selling calls and buying puts is a hedge. And then, of course, one of your favorite, actively trading futures. Right? Actively trading futures is a very, very good way to hedge the market because if you're short the NASDAQ, but you have a bunch of tech stocks that are long, if and when the NASDAQ crashes and has a big dip, your futures contract will pay off and you'll have some green there in your portfolio and the red will be in your stock account. I don't think that shorting the Qs relative to buying or shorting an NQ contract is even remotely equivalent. Like shorting the QQQ right now requires like 70 grand of margin minimum and the stock has to drop 10 points for you to get $1,000. But if you short an NQ contract, I mean, 100 points is $1,000. And like, that's the easiest, that can happen in 2 hours on the NQs. So learning how to do that is very valuable. Knowing how to day trade, believe it or not, is a very good hedge, in my opinion. It really is. Because if you are trading something that gaps really big against you, if you're trading stocks, or there's some type of big move, or you're able to read it or see it or understand it or look at a pattern and kind of feel like something's about to happen based on some evidence, and you take a quick pop in there and capture 1% on the downside. That's why I would probably say like 60% of my day trades are bearish, 40% are bullish because I'm already net long in my portfolios. I'm a Taurus. I was born in May. I'm already a bull. So me going bearish generally is quicker, faster. Hedging trades, futures trades, day trades. I don't really personally view gold and silver as a hedge. I'm not saying it's not. I just don't view it as one myself because they're going to go up. If the market crashes, gold is going to crash. Like the amount of times that gold has gone up significantly during a stock market crash is very rare. It might happen for a day or two, but over the course of a month, if the market's going down, gold, silver, they're going down. Even during the whole tariff thing, people saw that. So that's one. Man, there's so many cool ones. I've never traded Forex personally, so I don't know if Forex would be a good hedge or not, but probably. I don't know why not. And then obviously, man, tangible real estate, right? Tangible real estate is absolutely a hedge because if you can afford the position, if you can afford the house that you're buying or the apartment complex that you're investing in or the fourplex or the quadplex, and you can have what's called a 50% debt to income ratio or debt to value ratio. That's a big one, man. A 50% LTV, loan to value, is a big one for a piece of real estate, because the reason that most people, if and when you get a big economic collapse in real estate and people lose, is because they were over leveraged, right? They just had too much leverage on the home. They owed too much. And so the bank could come after them and take and call their note because they owed so much on it. But if you have a home, investment property, an Airbnb, a lake house, or whatever, and you only owe 50% on that home, mobile home park, storage container, RV park, commercial building, it's very hard to take that from you. Very hard, because what's the likelihood that we're going to get a 50% crash in real estate? Extremely rare. I'm not saying it can't happen, but that's happened like twice in America's 2008 and the Great Depression. And even then, not everything fell 50%. Some things did, but not everything. So that's another way to hedge. And there's tons of other ways to hedge, man. The other one to me is just be smart. Be really smart. Opportunity never goes away. It only changes places. So if someone can sit here and say to themselves, all right, the market's going down. I see the market's going down. I have losses here in my account. Is there something else I can do in business? Like when you started this podcast, that was you saying, hey, I want to trade and create impact and potentially make a little bit of revenue doing something else. You got smart. You said, hey, I can trade and make money in business. I can trade and I can make money in markets. And so you start adding things to your plate that any person can do, creating more income. More income is always a hedge as well.
Is there a rule when it comes to how much cash you should have versus how much investments, either in the stock market or in real estate? Do you have a specific rule for that?
The quick and dirty is, in real estate, if the real estate position can pay for itself and you have a 50% loan to value, you don't have enough. Like you could have literally as much as you want, and you're good to go forever. When it comes to stocks, my hard and fast rule is, if the market is down 30% or more, I'm not going to be very terrified of having some margin into the market, because you're going to have some big swings. When the market's up 30%, like we are right now, I'm going to have at least 50% in cash at all times. At least 50% in cash. So when the market's down 30%, I have no fear, no worries, no problem being in margin, using margin, playing with it, selling some puts on margin, buying shares. Like I really don't have a problem tiptoeing into the market at that point and accessing that line of credit. When the market's very high, again, 30% or more, 30% is just kind of my number. 30% or higher, 50% or cash or more. And that, when I say market, I would say the S&P 500 or the NASDAQ. Not necessarily year to date. I mean, it could be, right? If it's a YTD, year to date, 30%, sure. But if it's like, let's just say you're looking at a chart like, wow, the last 6 months, we're up 30%. Kind of like we are right now, right? That's a really good time to have some cash, definitely.
I mean, we covered a lot here for sure, and this is a lot of good knowledge. Is there anything else that we didn't focus on that you want to add to this or you want to mention?
I think mindset is a very underrated part of this whole trading thing, investing thing. And when I say mindset, I really just mean, like, what do people believe about themselves? What do people believe about the future? What do you believe about money, about stocks, about companies, about wealth? What is your actual true belief around that? Back to the whole like filthy rich. Like, what is it that you say all the time about money? What is it that you say all the time about time? What is your current constant story that you give to yourself, about your trading skills, about your portfolio, about your time commitment? Be very careful with the words that you say out loud and the words that you say to yourself, because the words you use create the world that you live in. So if you want a more positive, prosperous, abundant life, start speaking to yourself in those ways.
The way people can find you and connect with you after this podcast, where they can reach out to you.
Reach out to me on any social media platform. I would love it. Me and you are, we're both big on YouTube, Instagram, Twitter, all the social media platforms would be stunning. Perfect. I'm there. I have a really great team. So if you reach out, I'll make sure we get it done.
Awesome. Jerremy Newsome, pretty much everywhere. So that's pretty awesome. And people can reach out to you there for sure. I appreciate your time here. It's been good knowledge for sure. Good discussion. I appreciate that. And hopefully people can get value from this and apply it and then grow their wealth over time.
Let's do it, my man. So proud of you, bro. Thanks so much for the invite and the opportunity.